The stock market just broke a new record high, this time because three things happened. Number one, we just got new guidance from the Federal Reserve Bank saying that they want to continue cutting interest rates. Number two, we got some more guidance on the potential Trump tariffs. And number three, it looks like Americans are feeling more confident in the economy. Now, I want to start this video by saying this. Anytime you see the stock market breaking new record highs, you see two camps of people form. One side are people saying the markets are going to keep going up and up and up and nothing bad can ever happen because we forget that market crashes and corrections happen. And then the second camp of people are those that are waiting for the crash to happen and think that nothing can continue going up and that the markets are on the verge of a collapse. And what I want to remind you is nobody knows. You can listen to all the billionaires, you can listen to all the banks, you can listen to every hedge fund. Everybody is guessing, and at the end of the day, a guess is just a guess. Everybody has a couple financial opinions. They're kind of like armpits, and some stink more than others, but the reality is nobody knows. Here's what we do know. This is facts. What we've seen is over the last 100 years, the stock market has seen about 16 recessions. Yet despite those 16 recessions we have seen in the last 100 years, markets are still higher today than where we were 5 years ago, 10 years ago, 50 years ago, and 100 years ago. And so if history is in any indication of the future, we know that markets go up and they go down. Nobody knows when it'll go up, nobody knows when it'll go down, but if you are investing for the long term into the stock market, it has been proven to be a good wealth building tool. But that requires you to be a long-term investor, not a trader, not somebody who gets caught up in the emotions and all the hypey stuff. It's for the people that actually understand how investing works. So I wanted to just give you that little piece of disclaimer that understand markets go up, markets go down, and over the long term, well, time in the market beats time in the market. That's what Warren Buffett, the great investor, says. Now, I want to start by breaking this down into the three parts that I talked about earlier. I want to talk about interest rate cuts, I want to talk about the Trump tariffs, and then I want to talk about Americans and their confidence in the economy. Starting with interest rates, the Federal Reserve Bank just released their most recent meeting minutes. And the reason why Wall Street liked it is because it confirmed that the Federal Reserve Bank is still planning on cutting interest rates, although it might be more gradual. Here's what the meeting minutes said exactly, quote, "In discussing the outlook for monetary policy, participants," meaning the Federal Reserve Bank officials, "anticipated that if the data came in about as expected, with inflation continuing to move down sustainably to 2%, and the economy remaining near maximum employment, it would likely be appropriate to move gradually to a more neutral stance of policy over time." What does that mean? According to the Federal Reserve Bank meeting minutes that we just got, if we continue to see inflation kind of stay where it is, it doesn't have to come down to 2% right now, even though that's what the Fed says that they want. They want 2% inflation. We don't have to have that today. And as long as we don't see a major collapse in the job market, well, then you can expect the Fed to keep cutting interest rates. That's essentially what they said. It was not really anything groundbreaking or anything new, but it gave Wall Street some reassurance that, okay, it sounds like they'll keep cutting interest rates, at least gradually. So that's the first part of the news. The second part has to do with Trump tariffs. Now, the Trump tariffs have kind of gone both ways on the economy. Some people are going to say that it is going to help the economy. Some people are saying it's going to crash the economy because the prices of things are going to skyrocket. Well, what the stock market does not like is uncertainty. And what we got is some certainty. Not full certainty, but some certainty. The first point of certainty that we got is Trump has picked his Treasury Secretary person. And his person that he picked is Scott Bessent. And Scott, while he likes tariffs, kind of calmed some investors' concerns about tariffs because what he said is, quote, "Tariffs are a useful tool for achieving the president's foreign policy objectives. However," he's calling for these tariffs to be, quote, "layered in gradually." So that calmed the investors that are concerned about tariffs, because essentially what he's saying is, yeah, tariffs are good, but don't worry, we're not going to slap them on to the countries. We're going to ease them in gradually. So that calmed some investors. But then, along with that, Trump also gave a statement where he said that he wants to impose a 25% tax on all products that are entering the United States from Canada and Mexico, and an additional 10% tariffs on all goods from China as one of his first executive orders. So we have a little bit of a mixed bag, but investors are hoping that maybe because of this Treasury Secretary pick, that maybe we're not going to be as aggressive with the tariffs. Now, we've been covering all of this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in the economy, in the stock market, in the housing market, in crypto, and the global economy into a fun and witty and easy to read newsletter. You can read it in less than 5 minutes every morning and it's completely free. We publish Market Briefs 6 times a week and we have hundreds of thousands of investors that read it every morning. So if you have not joined Market Briefs yet, we would love for you to join, and it's completely free. If you want to join, all you gotta do is click the link down in the description below to join. So now we talked about tariffs, we talked about interest rates. Now let's talk about the economy, because we just got data saying that consumer confidence is booming. Now, consumer confidence is a measure where economists essentially survey people and ask them how they feel about the economy in many different ways, including things like the job market. And here's the data that we got. Quote, consumer confidence continued to improve in November and reached the top of the range that has prevailed over the last 2 years. That's directly from the report. So essentially what it's saying is we are near our 2-year peak of consumer confidence. And the reason why American consumers feel so strong about the economy is because the labor market. It says because the job market is looking stronger and because people are excited about future job opportunities. We have reached this high that we have seen in almost 3 years. The highest consumer confidence, especially when it comes to the job market, in almost 3 years. And this is where many economists are excited. Now you might be wondering, why does that even matter? Why does consumer confidence matter? Because unfortunately, economists understand that Americans are emotional spenders, period. And our economy runs on spending. The more money you spend, the more money somebody else earns, and the more our economy grows. So if Americans are spending money, the economy is growing. If Americans are not spending money, the economy is not growing. So if Americans are confident in the economy, they're more likely to spend. We have seen this, studies will show you this, that as consumer confidence goes up, Americans are more likely to spend. And not just that, Americans are more likely to go into debt to spend. Now that might not sound like a good thing for people that are spending money, but it's good for the economy and it's good for the stock market because, well, when people spend money, that keeps the economy moving. That's how our economic system works. Now, whether you hate it or love it, I just want you to understand it. And this is why consumer confidence is an important measure for investors, because they look at that and they say, if consumer confidence is strong, people will keep spending and that might keep helping the economy and different markets. But along with that, we also have some interesting news happening in the housing market, because we just got some data which says the housing sales have fallen to the lowest point that we have seen in 2 years. And this is where the National Association of Realtors just commented on this, because this data just came out. The chairman of the National Association of Realtors said this, quote, the decline in new home sales highlights the pressures on prospective buyers who are navigating tighter budgets and higher borrowing costs. This drop also reflects a slowdown in buyer activity and broader economic uncertainty. What does that mean? Well, a slowdown in sales doesn't mean the housing market is crashing. It means less transactions are happening. And what we have seen, I made a video about this just a couple of days ago, is that the housing market is starting to change. And by change, what I mean by that is we are seeing, number one, more inventory in the market. And trust me, I didn't believe it either, but that's what the data says. I showed you that in my previous video, that we have seen inventory of homes rising. And we're not seeing new homes being constructed per se that is leading to this boom in new inventory. What it looks like is homes are staying on the market for longer. And there's a lot of reasons why homes might be staying on the market for longer. Maybe there's not as many buyers, maybe buyers are being pickier, maybe they don't like the homes. For whatever reason, homes are staying on the market longer. And what that has led to is now we're seeing a larger inventory of homes that are available for sale. Now, trust me, I get it. If you're looking for a home, it's still hard to find a house. I'm not saying it's easy. Even I know, because I'm looking for a house to buy, and yeah, it's tough. But that being said, we are seeing a little bit of a shift. Because if homes are staying on the market longer and we're seeing less transactions, well, that gives a little bit more buying power to the buyer. Because if homes are flying off of the shelves, if homes are being bought like this, then it's very hard for you as a buyer to negotiate. It's very hard for you to come in and ask for more things when you're going to make an offer. But when homes are staying on the market for a little bit longer, that's when you start to see more price cuts, and that's when you start to see more negotiation ability. And that's what we're seeing happen right now. We're seeing more price cuts on the market, and we're seeing more negotiation ability. Now again, are we seeing a housing market crash? No, not yet. We're not seeing anything close to that. We're seeing a little bit of price cuts, which is very different than what we've seen over the last 3 or 4 years. But this news is particularly bad, not for home buyers or sellers, but more particularly for the realtors and mortgage lenders. Because housing transactions ultimately mean the number of homes that are sold. It doesn't mean the home prices are falling across the country, because overall, year over year, home prices are up. Now, I get it. Housing prices are localized. Some neighborhoods are down, some cities are down. But overall, across the country, housing prices are up year over year. But for realtors and lenders, they're the ones that are really feeling the burden of this, because if you're a realtor or lender, you are paid by transaction. You're paid on commission. So the more transactions you do, the more checks that you get. When there are small amounts of transactions, there are fewer transactions, you're closing less deals and you're making less money. So when you hear less housing transactions, the person that really affects is the realtor and the lender, because that means they're making less commissions. Now, each commission check that a realtor and a lender is getting today versus 5 years ago is more, because housing prices are a whole lot higher. But the number of transactions are falling. And that's something you want to pay attention to, because if you're in the market to buy or sell a house, well, if we continue down this path, because we don't know what's going to happen for sure. I mean, we don't know exactly where mortgage rates are going to go. We don't know exactly where the housing market is going to go. But what we do know is if homes stay on the market for longer, it gives buyers more negotiating power. And if buyers have more negotiating power, well, then that could potentially pull home prices a little bit lower. But we also know that Trump wants to cut interest rates. He wants to cut mortgage rates, although he doesn't have that direct power. We can bet that he's going to put pressure on the Federal Reserve Bank to cut interest rates. He's going to put pressure into the mortgage market to get lower mortgage rates out there. That could do two things. Number one, it could make it easier for somebody to go out and buy a house, because you qualify for a 5% mortgage as opposed to a 7.5%. And the second part to that is it might entice more sellers to sell their house too. Because you have a lot of sellers that are sitting in their house with a 2.5% mortgage or a 3.5% mortgage, saying we don't want to sell, because then we'd have to go to a 6 or 7% mortgage. We don't want to take that price hike. So people that own homes are saying we don't want to leave. Maybe lower mortgage rates could entice more sellers to leave or refinance, which could help the mortgage lenders, but we don't know what's going to happen. And so this is where my goal for you is not to tell you what to do, but to get you to understand the different things that are happening in the economy right now. That way, again, you can be a smarter investor, because I didn't tell you this earlier in the video, but I'm going to remind you, because I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. And what we know right now is, well, nothing is certain. It's always what it is. Markets are breaking new highs, and the way that you win as a long-term investor is you ABB, always be buying. You buy when markets are up, you buy when markets are down, you buy when markets are sideways. When markets go down, people lose their minds and you tell you you're stupid for buying and that you need to get out when you can, but that's the time where you just keep buying like normal. When markets are going up, you have people that are saying markets are going to crash, nothing can keep going up, it's going to fall, this and that. You just keep buying. When markets are sideways, people are talking about how the economy is no longer going to grow, that we're not going to see the growth that we had seen in the past. You just keep buying. That's the true way that wealth is built. Now, again, you can be a little bit more sophisticated, being more involved, what I like to call more of an active investor, where you're looking for more shifts, where you're looking for unique opportunities. That's fine. But the psychology still stands still, where you got to understand that the way you win as an investor is by being a long-term investor and not by being a trader. Trading is, to me, it's like gambling, because nobody knows what's going to happen in the markets tomorrow. I mean, you could see good economic news and the stock market falls. So the stock market is very risky in the short term. What we have seen is that over the long term, it has been one of the biggest wealth building asset classes out there. I mean, stocks, real estate, and starting a business are the three asset classes that have built more wealth than anything else over the last century. Does it go directly up? No. We've seen housing market crashes. We've seen stock market crashes. We've seen many businesses go bankrupt. But over the long run, those are the three assets that have built more wealth than anything else. And with that, everybody, I'll see you on YouTube tomorrow. Yes, I'll be keeping to publish videos throughout the holiday week, but have a happy Thanksgiving, and I'll see you on YouTube tomorrow.